Welcome to Tikona Capital FinServe's Market Outlook for June 2025. I'm excited to share our comprehensive analysis of current market trends, opportunities, and strategic insights that will help you navigate today's dynamic investment landscape. At Tikona Capital FinServe Private Limited, your investing co-pilot, we provide comprehensive wealth solutions for working professionals, HNI clients, and family offices. Our services include equity model portfolios, mutual fund solutions, differentiated PMS offerings, unique AIFs, unlisted equities, startup investments, and IPO advisory services. Our philosophy centers on creating finite solutions in an environment of infinite financial possibilities. Important disclosure: investments in securities are subject to market risks. Please read all documents carefully before investing. This presentation should not be considered as investment advice. Please consult your financial advisor before making investment decisions. Past performance does not guarantee future results. For information and detailed disclosures, visit our website at tikonacapital.com. Our June outlook focuses on 10 critical market themes. We'll review global growth downgrades, shifting tariff policies, rising bond yields, US debt concerns, and post-conflict market behavior. We'll also analyze India's macro strength, RBI's surprise rate cuts, corporate results, equity rotations, and key risks to strategic positioning. Let's dive in. Global growth projections have softened. The US is slowing to just 1.7%, China faces further downgrades, and Europe continues to struggle with near-zero expansion. In contrast, India still stands out with the highest GDP growth and manageable debt levels, reinforcing its long-term positioning as a global growth outlier despite worldwide economic weakness. Tariff policies remain inconsistent, with frequent pauses, rollbacks, and postponements across major economies. The US has delayed tariffs on Europe, floated lowering tariffs on China, but reinstated others. This flip-flop in trade policy fuels volatility in currencies and bond yields, keeping global investors cautious about stability in cross-border trade flows. Bond markets are signaling fiscal stress. The US 10-year yield has risen to about 4.5%, while total debt continues to soar past $36 trillion. With oversupply and inflation concerns, bonds are undersubscribed, pushing yields higher. Investors need to stay flexible and tilt toward short bonds, real assets, and equities with strong pricing power. Credit default swaps on US debt have spiked above peers like Spain and Portugal, signaling rare structural risk in a developed economy. With over $7 trillion needing refinancing, fiscal uncertainty is mounting. Global investors are increasingly seeking emerging market allocations, where debt burdens are more manageable and growth prospects stronger. China's trade surplus climbed to $96 billion in April, while US deficits narrowed due to falling imports. Tariffs are reshaping flows. China's exports to the US dropped over 20%, while other Asian markets gained share. For India, this environment creates both opportunities in diversification and challenges from global trade disruptions. In global markets, risks often emerge without warning. Rising fiscal deficits, growing de-dollarization trends, and unresolved US debt ceilings represent potential flashpoints. Lack of immediate signals doesn't mean lack of risk. Investors should remain alert to structural vulnerabilities and maintain hedges against sudden shocks. The Reserve Bank of India cut repo rates to 5.5% and CRR to 3%, infusing up to 2 lakh crore in liquidity. Bond yields dropped 18 basis points, signaling confidence. Meanwhile, the US Federal Reserve has held rates steady for the third consecutive time, prioritizing caution amid mixed economic data. GST collections in May 2025 reflected resilient consumption, crossing robust levels despite some monthly fluctuations. Healthy tax inflows point to strong business activity, though stability in demand remains essential to sustain revenue momentum through the rest of the year. India's macro indicators remain steady despite global turbulence. PMI slipped to 57 but stayed in the expansion zone for 45 months. Core sector and IIP growth slowed, while credit growth moderated to single digits. The trade deficit widened, but domestic demand continues to anchor the economy, pointing to gradual recovery ahead. India's GDP growth came in at 6.5% for FY25, with Q4 growth peaking at 7.4%. Inflation dropped to a multi-year low at 3.16%, supported by easing food and fuel prices. At $4.18 trillion, India is now the world's fourth largest economy, overtaking Japan. Bond yields eased in May, with the 10-year government bond slipping to 6.18%. Strong corporate issuance, narrowing spreads, and steady liquidity indicate a well-managed debt market. Credit growth from banks and NBFCs remains solid, though rural lending continues to lag, highlighting the need for balanced expansion. A sharp fall in interbank rates like Mumbai Interbank Offered Rate signals a significant shift in system liquidity, moving from a deficit to a surplus. This fast transmission of lower rates will benefit rate-sensitive sectors and discretionary consumption, providing a tailwind for the economy despite ongoing global headwinds. Gold peaked near 9,800 rupees before stabilizing, while crude averaged $66 a barrel as OPEC confirmed supply hikes. The rupee held firm around 85 per US dollar, supported by RBI action and rising forex reserves, which climbed to nearly $693 billion, close to record highs. The Indian rupee is demonstrating remarkable resilience. While the US dollar is strengthening against the Japanese yen, it is weakening against the INR. The Nifty's 5.8% rally alongside a 1.5% rupee appreciation reflects robust investor confidence in India's superior economic momentum compared to other major economies. Now let's examine the equity market performance and investment opportunities. Small cap and mid cap equity funds delivered the strongest one-month returns, while large cap categories provided steady performance. Gilt funds outperformed across debt, supported by easing yields. Hybrid and thematic strategies, especially manufacturing and transportation, led 3-year returns, signaling selective opportunities for investors. Global equities rallied with Nasdaq and DAX leading developed markets, while Chinese indices posted strong rebounds. In India, SME IPOs and small-cap indices outpaced broader benchmarks, highlighting risk appetite among domestic investors. Sectorally, real estate and CPSE stocks outperformed, while FMCG and commodities lagged. Fee inflows rebounded in May with nearly 15,000 crore rupees, while domestic investors contributed over 56,000 crores. Mutual funds added strong inflows supported by record SEEP contributions of 26,688 crores. IPO markets remained vibrant, particularly in the SME segment with oversubscriptions exceeding 50 times. May saw robust IPO activity across manufacturing, real estate, and debt. Smaller IPOs such as Skoda Tubes and Borana Weaves recorded massive oversubscriptions, while larger issues like infrastructure players struggled to attract demand. Investor enthusiasm remains high for niche and sector-focused opportunities. Unlisted IPO-bound stocks surged, with NSE valuations climbing 50% ahead of its anticipated listing. Approvals for large issues such as HDB Financial Services and Hero FinCorp added momentum. Sectors like renewable energy and financial services continue to attract significant pre-IPO investor interest. Now let's have a look at our investment strategy and future outlook. Earnings calls for Q4 FY25 revealed sources are still concerned about uncertainty. Inflation, competition, and macro headwinds dominate sentiment. Many corporate leaders remain cautious about demand visibility, rate environments, and global risks, keeping expansion plans selective and measured. Despite uncertainties, source emphasized product innovation, capacity expansion, and government-led initiatives like PLI schemes and defense contracts. Selective optimism exists in sectors tied to policy support, signaling potential growth opportunities in manufacturing, defense, and infrastructure. Large cap valuations remain close to long-term averages, with the Nifty trading at 21 times forward earnings. However, mid-caps and small caps trade at premiums of 30 to 60%, reflecting elevated optimism. Sustained earnings acceleration will be critical to justify these valuations going forward. Autos saw mixed results with tractors outperforming, while two-wheelers remained under pressure. Banks reported divergent margin trends, with private lenders improving and PSU banks moderating. NBFCs continued solid growth in ARM, while cement volumes rose 11% despite margin pressures. It showed weakness in Tier 1 firms, but mid-tier players like Coforge and Persistent delivered growth. Healthcare and metals posted strong year gains, while consumer staples faced soft demand but are poised for gradual recovery. Global GDP forecasts were revised down to 2.9%, with US and China growth decelerating. Europe continues to stagnate despite fiscal stimulus. In India, GDP growth of 6.5% and inflation at 3% reaffirm macro stability. RBI's surprise rate cuts support liquidity and credit flow, cushioning risks from global volatility. We maintain an overweight on Indian equities, supported by selective mid and small cap opportunities. Debt allocations in G-Secs and AAA rated bonds remain attractive with stable spreads. Sector rotations favor financials, defense, and infrastructure, while global themes like AI and renewable energy provide diversification. Key risks include oil price spikes, currency volatility, and global policy uncertainty. Our recommended allocation for June is 70% equities, 20% debt, and 10% alternatives. Within equities, focus remains on financials, defense, and EV-related sectors. In debt, longer duration bonds are preferred. For alternatives, opportunities in unlisted markets, renewables, and SME-linked products hold long-term promise. At Tikona Capital Finserv Private Limited, we believe in creating finite solutions in infinite possibilities. Our triangle logo represents filtering out unknowable edges from the ultimate circle of market uncertainty. Founded and led by Sumit Poddar, our team is committed to empowering customers to invest in high-quality businesses and build long-term wealth. Connect with us at tikonacapital.com, follow us on LinkedIn, YouTube, and Twitter. Thank you for watching, and remember, invest with conviction, build long-term wealth.